everyone. Today's session is Learning Outcome 3 on Law for Accounting, and my name's Shazia Khan. And we're going to be doing Learning Outcome 3 today in regards to the impact of criminal law on businesses and professional organisations. Before we go on to Learning Outcome 3, I just want to give you a summary of what we did in the last session, which was Learning Outcome 2. So in Learning Outcome 2, we looked at the formation of a company. So what is a company? And how it's different to an incorporated or corporated company. We looked at the types of companies. So you have private or public companies. And we also looked at the veil of incorporation in regards to company. We referred to elements of the veil of corporation in regards to types of companies. So you have public companies which are limited by shares. Then you have private, you have limited and unlimited by shares. And you have private limited companies and public companies. And we looked at the difference between each one in regards to things like their definition, the name, the capital, how each one, public or private, raise capitals, the start of trading and directors. We then went on to look at the elements of incorporation. So why is it so important in regards to having a separate legal entity? We looked at the ruling in the case of Foss and Harbottle, where the elements of individual shareholders, where they cannot sue for wrongs done to a company. We went on to look at companies law within Companies Act 2006. We looked at company law includes parts of like securities regulation and insolvency rights. We looked at them. We then went on to look at corporate governance in regards to company law, and we looked at the core company law and corporate governance and how they overlap with each other. We then went on to look at the various sources of company law. So we looked at the different legislation and the acts within company law, because it's so important that, you know, companies are run in reference with these acts so that they're governed. So Companies Act 2006, Insolvency Act 1986, the Companies Directors Disqualification Act 1986, Financial Services and Markets Act 2000, Criminal Justice Act 1993, so we looked at the insider dealing, and Companies Act 1985, and Companies Act 2004. We then went on to look at 2.1, which was to analyse the requirements of company for formation, financing, and administration of companies. We looked at the shares within limited liability company, LLC, and private limited company, PLC. And we looked at why it's so important to form a company and what the procedure is. We also looked at advantages of forming a company and how a company is formed through Companies House. We looked at the procedures such as using the form called an IO1 form, a Memorandum of Association and Articles of Association. We looked at how it's important to consider the company name and what are the requirements for picking a company name. We also looked at the shareholders and share capital of a company. We looked at the directors and what they do within a company and why they're so important. We looked at the secretary within a company. We then went on to look at registered office AD01 as part of the formation process, and why it's so important in looking at elements of that. We went to look at constitutional documents, articles of association and memorandum of association. We looked at importance of each one in regards to Companies House and registering a company. We went on to look at 2.2, which was to analyse the role and responsibilities of company directors, officers and shareholders, and looked at the requirements and the general duties within Companies Act 2006 and what they identify in regards to a duty of a director or officers and shareholders. We then went to look at, under Learning Outcome 2, the general duties of a company director. direct duties and indirect responsibilities. We then went on to look at duties of a shareholder. So things like to attend general meetings and vote, to receive a share of the company's profits, to receive certain documents from the company, to inspect statutory books and, winding up of a company as well. We then went on to look at the duties of shareholders within things like ordinary resolution and special resolution and what the procedure is under Companies Act 2006. We then went on to look at 2.3, which was to explain the process of insolvency for business organisations and why that is so important in regards to winding up or liquidating a company. We then went on to look at the Insolvency Act 1986 in regards to insolvent companies and the elements of that. We then went on to look at insolvency and administration. Securities regulation, the aim of securities regulation, we looked at why they were an important part of the elements of finance law. We went on to look at the global financial crisis of 2008 and what impact that had on the society as a whole. And we looked at 2M1 to advise on the insolvency process for a given situation. So we looked at a given situation, a case study, scenario 1, use of insolvency system by creditors to initiate bankruptcy liquidation proceedings. And then we looked at 2D1, we looked at analysing aspects of capital maintenance. So what capital maintenance is, why it's so important within an organisation, and what's the use of capital maintenance. We then went on to look at the reduction of capital maintenance under Section 641 of Companies Act 2006. We went to look at procedure for public companies. So they pass a resolution, special resolution, apply to the court to confirm the special resolution. If reduction involves one of the first two methods above, the court must require a company to settle a list of creditors, and the court must not confirm the reduction until it's satisfied that all creditors have either consented to the reduction or have had their debts discharged or secured. And then we looked at the company must file documents within the registrar if the share capital of the company falls below 50,000. We looked at the procedure for private companies. So they pass a special resolution supported by a solvency statement. The solvency statement is a statement by each of the directors that the company will be able to meet its debt with the following year. And also a solvency statement made without reasonable grounds is an offence, and copies of resolution and solvency statement must be filed with the registrar within 50 days. We looked at also some additional information on treasury shares. What's the importance of treasury shares within a public company? And we looked at the exceptions under Section 724 of the Companies Act 2006. Alternative investment market, and also Section 726 of the Companies Act, where the shares will not give the company any voting rights, and Section 729 of the Companies Act 2006 in the event the shares are cancelled. We then went on to look at Section 730 of the Companies Act 2006, which states that treasury shares are cancelled. The company must deliver a return to the registrar not later than 28 days after the shares are cancelled. We then went on to look at the amount paid up and unpaid of each share, and treasury shares and how they can be created. So we looked at elements. These was additional information in regards to Learning Outcome 2. We now finished Learning Outcome 2 and are moving on to doing Learning Outcome 3, which is today's session. So the slides are up there. So we'll go through Learning Outcome 3. So you've got an idea of what we're looking at. So in Learning Outcome 3, we're looking at elements of trying to understand the impact of criminal law on business and professional organisations, and why it's so important, because it plays a big role within issues of fraud, money laundering, things like that. So we'll be looking at elements of different elements of malpractice and any sort of elements of fraud or bribery. So the indicative content for Learning Outcome 3 is to look at the legal principles, legislation, case law, and ethical codes. So what is the difference between them and why they're needed? Ethical codes relating to business professionals, government guidance, why ethics is so important within a business, why law and regulations are so important within any elements of malpractice, bribery, corruption, fraud. We also will be looking at what constitutes money laundering and failing to comply with any sort of requirements and what the penalties are, and computer misuse and cybercrime as well we'll be looking at. So learning outcome 3 assessment criteria. Firstly, 3.1, to analyse the relationship between legal principles, legislation, case law, and ethical codes. And this is one part of your assignment, which you will be expected to do as well, to look at elements of that. 3.2, to explain the elements and consequences of malpractice, fraud, and bribery in business organisations. 3.3, to explain offences and penalties relating to money laundering. And 3.4, to explain offences and penalties relating to computer misuse and cybercrime. And we'll be looking at that in more detail so you have an idea of what each element means so that you're able to answer your assessment criteria questions. So firstly, we look at 3.1, analyse the relationship between legal principles, legislation, case law, and ethical codes. When we look at legal principles, the first element, ethics and ethical behaviour, are values and beliefs of individuals, you know, and organisations in their organisations, and they follow a code of conduct. It's so important that they follow this code of conduct to identify, you know, why important ethics is in regards to them. You know, ethics is in an organisation. Is the application of ethical values of the organisational behaviour. It applies to organisational conduct, your corporate governance. It looks at employment practices, stakeholder relationships. You know, if you know, ethical practices is so important because it's based on the reputation of the organisations. You know, delivery services. Ethical practice is not only an effective insurance policy mitigating risk, it gives an organisation competitive advantagement. So it's really important that a firm or an organisation establishes this ethical culture within their organisation on a day-to-day running of the organisation. You know, a company may have excellence as value, but how excellence is defined in an organisation, how it's achieved, is it with integrity or is it with at an expense, for example, you know, child labour or poor working conditions. So, you know, ethics is really important in parts of accountancy as well, that you are mastering a particular skill, you are, you know, ethical, you've got this ethical approach, you are achieving acceptance. So these are important elements of ethics. Codes of ethics, many organisations have to follow codes of ethics, okay? Being a professional body, you need to be registered and you must follow the codes of ethics. So if you're an accountant, you would follow the codes of ethics, you know, to follow things like, you know, you sign up to ethical characteristics. So things like, you know, money laundering, things like, you know, adhering to the code of practice of ethics, you know. So it is really important when we look at ethical behaviour, why is so important in regards to elements of conceptual, you know, code of ethics. You must follow it as a professional, and, you know, there are ethics, you know, that must be followed. Body of theory and skills, so technical skills. As an accounting profession, an examination system which ensures accountants obtain the knowledge and responsibility. So as an accountant, you must follow, you know, your CPD, make sure you've established by an administering body, so an authorised body, which is the ACCA's code of ethics that you must follow, that all members must maintain this kind of objective outlook. Also, professionals can be trusted in the act of public interest, and you have to refer to the code of conduct of ethics for an accountant. Ethics and ethical behaviour. Why behave ethically? So you have law and regulation, as we said, codes and practice, reputation and standing. As I mentioned, you know, a company's reputation is based on ethics. And maintain public confidence and protect your public interest. So maintaining this ethical climate within your organisation, you know, it might be an excellent organization, but it may be not ethically, it may not be, embedding any forms of ethics. So, you should be able to, put in best practices, avoid any sort of conflicts, be objective, and ethics program to support and bring value to life. Make sure you are bringing ethics into your organization and embracing these kind of elements. Fundamental ethical principles. So we have the accountant has fundamental ethical principles. So firstly being integrity, and it's really, most professions would fall within this as well. Integrity, so they need to be straightforward, honest, implies fair dealing and trustfulness. Objectivity, they need to be uncompromised by bias, conflict of interest, undue influence of others, and make sure there's no conflict of interest or bias, or they're not hypocritical. Professional competence and due care, so maintain professional knowledge and skill and act diligently. Make sure you are following the codes of practice. Make sure you are following the ethics, because if you are not acting diligently, then you are breaching the ethical principles. Confidentiality, and this is a big one. Lots of individuals, not just accountants, but other organizations do fall within breaching confidentiality and GDPR. So, refrain from disclosing any sort of information that is, part of the individual's private, personal information. Professional behavior, comply with relevant laws and regulations, avoid any sort of disrepute to any sort of actions being brought against you. So maintain your professional barriers, maintain your professional behavior, and also, maintain your professional competence when you are dealing with clients. The conceptual framework, so an accountant's codes of professional ethics sets out basic solving procedures. So they have to identify threat to a fundamental principle, evaluate the threat, apply safeguards. If safeguards cannot be applied, discontinue the action or service. Safeguards created by professional legislations that we must follow, and safeguards in a working environment. Types of threats could be self-interest, could be things like self-review, advocacy, familiarity, or intimidation. The principles versus rules. So the principles-based approach to ethics encourage case-by-case judgment. So advantage of principles are rigorous. So we comply with spirit. So we comply with the rules. Legal principles are needed to be complied with. The laws are changing, flexible, changing circumstances. Promote development of skills and judgment. Creates a culture of ethical awareness, and encourages personal responsibility. And these are principles. Advantages of principles, and disadvantages: not easy to find the right answer, maybe more than one course of action, and conflicting interests need to be balanced. The advantages of rules are they're clear-cut, the correct course of action will be more obvious, and they're easier to enforce. The disadvantages of rules are their loopholes can be found, and that could be the element in any sort of areas. They have legislation every eventuality. New requirements must be developed, and sometimes you miss the bigger picture. So when we go on to looking at complying with the law, there is elements of when we look at legal principles, there are general principles within different branches of law and the legal system. And these principles are often to the functioning of the legal system and ensure any sort of consistency, fairness, and the integrity of law. Some general principles, things like rule of law, making sure that everyone is treated equally. Separation of powers, there's a divide between the powers of the government in 3 branches. We have the legislative, executive, and the judiciary. Legal certainty, so demanding clarity, accessibility, and predictability of laws. This principle enables individuals and also businesses to understand their rights and obligations, fostering trust and compliance. And when we talk about it, the elements of it is that you must be following all the requirements of, your institutional body. You must be, making sure that you, are treating individuals with the same legal rules, access to justice, opportunities. A vital procedural legal principle is fair legal proceedings as well. you know, it depends on your, make sure you are, you know, making individuals, you are following the law when you are working in the accountancy profession, because for you, ethics is the most important thing, but also that you are abiding by what the law states. Because, you know, we have to, as, you know, as accountants, you have to, you know, make sure that you are following the ethical profession, you know, the fact that you are looking at policies and procedures established by ACCA and you are following them in regards to identifying integrity, clarity, confidentiality, professional boundaries, you know, things like that. So compliance with the law, like we said, it's really important that you comply with the law. Laws are in two categories. So you have criminal law and you have civil law. Criminal law affects the whole community and it's punishable by a fine or imprisonment, whereas civil law relates to conflicts within the community, and the concept, the punishment does not apply. So there's no form of like imprisonment or custodial sentence. Accountants are affected by laws which may not be obvious, so health and safety legislation, employment protection and equality, and laws and regulations must be complied with. An accountant's ethical code is not legally enforceable. Penalties are at discretion of the professional body, and they're subject to other regulations as well. So the accountancy, they have the International Federation of Accountants, which is referred to the the IFAC, and it's an international body that represents the ethical codes for professional accountants. You know, it's there for identifying fundamental principles within the elements of the code, which are things like, which I mentioned earlier, integrity, objectivity, professional competence, due care, confidentiality, professional behavior. These are something that, you know, accountants must follow with in regards to the code. And it's a framework that sets out to deal with ethics and independence. The conceptual framework actually clarifies that conditions, policies, and procedures within the IFAC are followed by professionals, legislation, regulation, the firm, or employing organizations to enhance PAs acting ethically, and not safeguards, because they are not specifically designed to deal with particular threats. So this framework is there to identify elements that you must follow as an accountant. Then you have the Consultative Committee of Accountancy Bodies, CCAB, as 5 members, of which 3 are sponsoring bodies of ATHE. Then you've got the HM Revenue, which is a UK department whose aim is to ensure that correct tax is paid. And then you have the National Crime Agency, is a UK body to tackle any sort of elements of serious organised crime, such as drugs, trafficking, fraud and money laundering, which we'll be looking at later on in more detail, so you have a better idea of that. You know, so it has to be something that is followed. So business ethics and professional values. So key principles which we looked at earlier: integrity, objectivity, accountability, openness, and honesty. And this is the ethics, the elements that they must be followed. You must follow them to provide that the decisions are fair, you know, and that you are complying with the regulations, because, you know, you need to be aware that you are complying with these regulations and you are making sure that you know, you are complying with them, but also you are following the procedures and the codes, because they are so important in regards to, you know, business ethics. Is business ethics is really the moral principle, policies and values that govern the way the companies and individual engage in any sort of business activity. It goes beyond legal requirements to establish a code of conduct that drives employee behavior at all levels and helps build trust between a business and its customers. So, you know, business ethics and professional values are really important for any sort of business to build that reputation. Business ethics refers to implementing appropriate business policies and practices with regard to arguably controversial subjects. A code of conduct, as we mentioned, is designed to influence the behaviour of employees. A code of practice is designed to obviously adopted by organisations to regulate its profession. Business ethics, when we look at it, it's there to ensure, like we said, a certain basic level of trust between consumers and various forms of market participants with businesses. For example, a portfolio manager must give the same consideration to the portfolios of family members and small individual investors as they do for wealthier clients. These kinds of practices ensure the public receives fair treatment. And you know, when we look at business ethics, the element of that began in 1960s as corporations became more aware of a rising consumer-based society that showed concerns regarding the environment, social causes, the corporate responsibility, and the increased focus on social issues was a hallmark of the decade. Since that, the concept of business ethics has evolved, and it's so important, and it goes beyond just a moral code of right and wrong. It attempts to reconcile the companies must do legally versus maintaining a competitive advantage over the businesses, you know. So there are many principles that you must follow to identify things like business ethics principles, things like leadership, accountability, which we looked at, reliability, honesty, respect for the law, transparency is really important as well, elements of compassion, fairness, loyalty, and environmental concern. You know, it is really important. Business ethics is really important in any business because it establishes a code of conduct that drives employees' behavior. But when all employees make ethical decisions, the company establishes a reputation for ethical behavior. So it's really important, you know, that company tries to establish this relationship because it builds their rapport. So sustainability and CCR. So in practice, many companies use the terms CSR, which is corporate social responsibility, and sustainability interchangeably. For example, some companies have sustainability strategies and a sustainability report, while others have the corporate social responsibility strategies and a corporate social responsibility report. Many companies have also started using the term corporate responsibility as a synonym for CSR. The concrete shape of corporate social responsibility varies from company to company. The CSR activities of a manufacturer will be different from those of a retailer. Publicly listed companies are confronted with other challenges than a family-run small business with deep roots in its regions. But all companies successfully implementing any sort of a corporate social responsibility have one thing in common. There's no way around anchoring corporate social responsibility in the company's activities. Companies will see their CSR activities as an add-on having nothing to do with their business model, and core business fall mark of that. You know, so many companies will follow the CSR model in regards to, you know, identifying any elements of sustainability as well. And it's so important within an organization. When you look at the role of sustainability, it's there for preserving any sort of the planet and natural resources like water and air. That's sustainability, and building a sustainable future and cultivating sustainable ways of life will reduce things like pollution and protect habitats of plants and animals. So sustainability is really important within a company, and CSR, they overlap, you know, within each other, and they work together. And companies can demonstrate their commitment to sustainable business practices by using the CSR corporate social responsibility. Governance, risks and ethics, why these are so important in regards to ethical behaviour. So when we look at in regards to accountants, you know, accountants have a responsibility to act in the public interest and the wider social responsibility, not just confined in environments, so sustainability and CSR. Governance, risk and ethics. So governance or corporate governance is the overall system of rules, practices and standards that guide risk or enterprise risk management. It's the process of identifying potential hazards to the business, acting to reduce or eliminate these final impacts. And things that are some potential governance risks are things like executive compensation, customer data usage, ECG investment decisions. In public sector, ethics refer to well-based standards of right and wrong and prescribe the public servants ought to do. Good corporate governance is an aspect of ethics, which refers to the set of systems, principles and processes by which public service organisations are governed. Business ethics, governance and risk looks at how the business model can be supported by ethical values and the critical role they play in building trust and creating a corporate culture that will reduce any sort of risk and value over the longer term. So they look at things like elements of that in regards to trying to produce, you know, trying to make sure that companies are directly and controlled properly, with that directors are acting on behalf of the shareholders, you know, and however discussion of running companies look at the ethics and corporate strategy, corporate social responsibility, which is CSR. So looking at the next part of it is, which is 3.2, looking at explaining the elements and consequences of malpractice in regards to fraud, bribery in business organisation. So when we look at them elements, we look at the elements of what each one is and why it's so important within an organisation. So bribery and corruption are serious criminal offences in England and undermine fair competition and erode public trust. The Bribery Act 2010 is the key legislation outlining various offences and potential consequences for individuals and organisations. The Act itself defines bribery as offering, promising, giving, or asking for an advantage, which is financial or otherwise, to influence someone improperly in performing a relevant function or activity. So it looks at the fact that we are, you know, it's a criminal offence, and this will can occur in domestic or foreign settings. So breakdown of key offences. So bribing another person, so offering or giving an advantage to influence their actions in any capacity, be it private or public. Accepting a bribe is another one, agreeing to receive an advantage in exchange for improper performance of function. Bribery of foreign public officials, offering or giving an advantage to a foreign public official to obtain business advantage in violation of their local laws. Potential criminal penalties for bribery and corruption. For an individual is maximum of 10 years imprisonment and an unlimited fine, and for an organisation it's unlimited fines, debarment from public contracts and reputational damage. Okay, so negligence, an act or omission which falls short of standard, the reasonable man and a duty of care would be an element in negligence. So when we look at financial crime, it's an important element of the sector itself. It looks at, you know, is defined as where an individual uses their own name to apply for financial product, but uses false information, you know, it's depriving someone of their money, capital, or otherwise harms their financial health through deception or misleading. So examples are identity theft, mortgage fraud, corruption, credit and debit fraud, fake charities, fake lotteries, debt collection. So there are elements of that. So the next part we're going to look at is what is corruption. So this is looking at the element of what corruption is. Corruption is bribery, okay? And it erodes trust, weakens democracy, hampers economic development, and exacerbates inequality, poverty. So the basics, corruption can come in many forms. So it could be public servants demanding or taking money or favors in exchange for services. It could be politicians misusing public money or granting public jobs or contracts to their sponsors, friends, and families, and corporate bribing officials to get lucrative deals. So corruption can happen anywhere in business, government, the courts, the media, and in civil society, as well as across all sectors from health and education to infrastructure and sports. It can involve a wide range of people, as we said, government officials, public, the business. It could happen in the accountant's office where they're looking at, different contexts. It can involve in changes in legislation. So it's a big element of it, and you need to make sure that you are, looking at the elements of corruption and trying to avoid any sort of corruption happening. Again, corruption in the form of facilitation of payments, as we mentioned, is an important one. And it's the abuse of public office for personal gain. It's things like it's important that corruption is not reduced to monetary form of corruption, that is bribery, but that a wide range of behaviours such as conflicts of interest, patronage, nepotism, embezzlement, that's happening quite a lot, peddling or manipulation of legislative processes, which we mentioned, with an ulterior corrupt objectives, and the notion of corruption. So it's really the distinction between facilitation and bribery is not always clear. Some countries criminalize facilitation payments abroad. Other countries, such as the United States, do not prohibit such payments. So there's a difference in different countries due to their jurisdiction and due to, their element of the laws in that country as well. Corruption and bribery. As we mentioned, bribery is the action of offering another individual something of value, notably money, in exchange for something which will be beneficial to the bribery. And corruption can apply to a large range of actions which are essentially conducted with illegitimate and dishonest intentions. So, they are similar but different in their own way as well. Example of corruption and bribery. Examples could include commercial bribery and kickbacks. Examples: paying procurement staff to sway their decision in favor of paying company, giving an expensive gift to a bank manager to secure a loan, and various forms of kickbacks. The law in the UK Bribery Act 2010 defines an advantage given to influence a person to carry out a function they don't want to carry out. And, it's easy to identify, a good example of corruption could be things like we mentioned, embezzlement, theft, or fraud. Within the accountancy profession, the UK accountancy profession is largely self-regulatory, with the accountancy bodies in UK Financial Reporting Council regulates the accountancy's profession to look at ethics and how the profession is run, and if there are any issues or, they enforce compliance in regards to that, and make sure that things are followed, people are following the laws in regards to it, and following the ethical side of it. So the accountancy profession, you have the different approaches in the accountancy profession. So you have the accounting profession actually looks at the elements of two approaches they have, is the reactive approach and the proactive approach. So the reactive accountant is someone who waits for the client or events to instigate any sort of activity. One example, if a client's cash flow issue arises, a reactive accountant might be able to coordinate an effective response that neatly solves the problem. Whereas a proactive accountant, however, wouldn't allow the issue to arise in the first place. By taking the initiative, the conditions that led to the cash flow issue could have been nipped in the bud and resolved before any problem developed. When accountants assume a reactive posture, they help create an environment where it's incumbent upon business owners to raise and help address any sort of concerns, something that inhibits growth. Instead of devoting resources to strategic thinking and planning, business owners get bogged down in the details of problems that could have preemptively resolved by an accountant with a more proactive approach, where that's the reactive one. Proactive accountants actually address looming issues before they become fully fledged problems. They make it a point to stay apprised of all the most recent developments, both in their industry and the industries of their clients. They are also deeply attuned to any change or variations in their clients' financial outlook, and they stay on top of tax payments and work to ensure that any of all financial blind spots are covered. And by doing this, they play an integral role in keeping things running smoothly and ultimately scaling the business. So when we look at public interest in regards to the element of what it is and what it is, what the meaning of it is, and why it's so important when we look at public interest. Public interest covers a lot of wide range of values and principles relating to public good or what's in the best interest of society. For an accountant, acting in the public interest for the collective well-being of the community and people that it serves is really important. There's much debate over a definition of public interest. However, the public interest is normally seen to refer to well-being or general welfare. So an action is usually thought to be public interest where it benefits society in some way. So it is unclear how many members society must benefit before the action can be declared to be public interest. So it's really important element of accountancy, having to identify, public interest. Why is it so important in regards to an accountant, having the public interest and looking at, society as a whole, in their profession. It's a contribution to business and society, and the accountant adjusts these actions to the standards of the members in regards to having that public interest for the accountant. It's the accountant profession has to look at actions of public interest by developing their standards and behaviours, monitoring, enforcing things. It has to follow the ethics as well as the public interest. Looking at how they are gonna look at the elements of codes of ethics, how they will follow that, the well-being or general welfare of the public interest. Explain, the next element of it is to look at explaining the elements of penalties related to money laundering and what money laundering is. Okay, so money laundering is defined in the Proceeds of Crime Act 2002 as the process by which the proceeds of crime are converted into assets which appear to have legitimate origins, so they can be retained permanently or recycled into further criminal enterprises. Money laundering can be broken into two categories. Firstly, those who commit offences and launder proceeds of criminal offences. The criminal offences are referred to as predicate offences. And secondly, those who only criminal involvement is to launder the proceeds of the crime committed by others. So it's really important when you look at these elements that what proceeds of crimes are, in regards to penalties around it, because it is a big issue around money laundering. Money laundering is a big issue that has, it's not just an issue that's been sustained now, it's quite a high issue that's been going on for a long time, where people have been more laundering their money in regards to trying to protect the money, and it's a criminal property. It's trying to conceal any sort of money in regards to it. So the maximum penalty, okay, for money laundering is 14 years. There are fines, also considerable fines. It can consist of jail time depending on the severity of the crime and the circumstances in which it was which the crime occurred. The maximum penalty for tipping off a money launderer is an unlimited fine and up to 5 years. Under the Proceeds of Crime 2002, as we mentioned, money laundering itself is only one of a number of criminal offences. Criminal offences relating to things like failure to report money laundering, which would be things like, accountants and lawyers and things like that, being unable to clearly prove that the source of income inquiry was legal when questioned, being involved in any other activity that has unknowingly undertaken in relation to money laundering or terrorist financing. So, it's really important when you look at money laundering, and especially in the accountancy profession, that you are able to identify where the money has come from and it's not being laundered. The definition is, quite clear on, saying that money laundering disguises the origins of the money. It's not a new phenomena. It's been going on for years, and it's a way that people hide their money. So offences under money laundering are principal offences, failing to report it, suspecting or tipping off, and the offence is 14 years, as I said, and tipping off 5 years, and failure to disclose 5 years. So, when it comes to it, accountants would have to disclose that. If you are an accountant, you must disclose any sort of issues that you know of money laundering. Fraudulent behaviour. Fraudulent in the legal context refers to actions or behaviour that are carried out in bad faith or with a dishonest intention. So it is a term that holds significant weight in the legal system and is often associated with serious consequences. As a business owner, it's crucial to have a clear understanding of what constitutes fraudulent behaviour and its implications to ensure compliance with the law and protect your business interests. Fraudulent behaviour can manifest in various ways. They include things like, misrepresentation, forgery, Ponzi schemes, and insider trading. These can be recognised by the courts as well. And there are many types of fraudulent behaviour, which we said: insider dealing, money laundering, bribery, fraudulent or wrongful trading. These are areas that need to be taken into consideration when looking at fraudulent behaviour and how it impacts on the society. There are a number of criminal offences that can be taken by the individuals. There are a number of criminal offences that could be undertaken by individuals, which failure for accountants, failure to file accounts and annual returns, failure to provide any sort of, information that's incorrect, providing misleading information to an auditor, and that under Section 499 of the Companies Act is a breach of that as well. So you need to make sure you are not providing misleading information. The next one to look at is business's company name. So from 4th of March 2024, the registrar is given new powers to require a company to change its name where the name has been used to facilitate offences involving dishonesty or deception, or the name has been wrongfully registered. So it's quite a recent thing, but under Companies Act, it's a criminal offence to use a name that requires prior approval if the approval has not been obtained. So this is more recently in 2004, and it's if you believe that a business or someone has infringed your trademark, you can, obviously get legal advice, but, you can identify that, your company's name is being used illegally, and you have the right to take legal action. Under Section 13 of the Company Directors Disqualification 1996, any person who acts in the contravention of disqualification order is guilty of an offence. So it's really important in regards to that to identify elements of that. Phoenix Phoenix companies. So phoenixing or phoenixism is the setting up of business multiple times to avoid paying debts. Each company becomes insolvent. Its business and assets are transferred to a new similar company so the same directors can carry on trading. A phoenix company is, as we mentioned, a reborn from a company that has failed. It's often the same directors, the same staff, same products, but should you do with them, it's important. Rising insolvencies mean they can become common. So, you know, there are lots of companies out there that do these Phoenix companies, and they fall within Section 216, 217 Insolvency Acts, which are referred to as Phoenix companies. An example is General Motors. Is an example of a Phoenix company, VIV Motors Liquidation Company, the original General Motors. So, you know, it's quite a growing thing within the UK. And, you know, Phoenix businesses, when a new company for little or no value continues the business of the existing company that has been liquidated or otherwise abandoned to paying their, which includes creditors and that. So, you know, it's an illegal Phoenix activity that needs to be looked into, and it's quite important with regards to identifying any elements of insolvency. Explain the offences and penalties related to company misuse. So introduced in 1990, the Computer Misuse Act makes it illegal to acquire access to a computer without permission and make changes to files on a computer without permission. The law has partly introduced response to that. There was a case called R and Gold and Shrivi in 1988, whereby they used conventional home computers and modems in 1984 and 1985 to gain access to British Telecom's Prestel Interactive View data service. And you can be found guilty of an offence under the legislation if you cause a computer to perform any function with the intent to access any program or data held in any computer when access is unauthorized and the person knows that at the time when they cause the computer to function that is the case. The Act itself is still used today, mainly in cases where people are facing accusations of data harvesting, hacking, and unauthorized encryption of data. According to the UK's Office for National Statistics, ONS, approximately 4.5 million cybercrimes are committed in England and Wales during 2018. So that's a huge amount, with 1.2 related directly to computer misuse. So you can see it's a total increase. However, there have been a series of amendments over the last 3 decades, with the most notably in 2015, which made life imprisonment possible in cases where human welfare or national security had been endangered. So computer misuse offences can be brought before the Magistrates' Court or the Crown Court, depending on the severity of the case. However, the different levels of penalties are: you could have up to 2 years in prison and a £5,000 fine for gaining unauthorised access to a computer. You could have up to 10 years in prison and unlimited fine, depending on the severity of the case, if you require unauthorised access to a computer to steal data or use the data to commit fraud. And you could do up to 10 years in prison and an unlimited fine if you modify the content of a computer or provide the tools so that others can alter the content, and up to life imprisonment if the computer misuse puts national security at risk or causes any sort of harm to welfare. With 1.23 million offences relating to computer misuse for the year ending March 2018, which is 4 years ago, 6 years ago, the ONS reported a 31% drop in cybercrime when compared to 2017. The decrease is a positive step, showing not just how important antivirus technology can be, but successful hacking offences also dropped by 12% to 528,000, suggesting people are more aware of security standards. So, you know, it's really important that, you know, as a business, you are not breaching any sort of penalties on computer misuse. The next element of it is the Fraud Act 2006. And this is a primary piece of legislation that deals with anti-fraud legislation in the UK and has been enforced since January 2007. In contrast to the previous legislation that it replaced, the Fraud Act established a clear definition and offence of fraud for the first time in the UK. And for the main offences established by the Act, it removed the element of deception as a characteristic of this kind of criminality. There are several new offences created, the main three sections 2, 3, and 4. The Act also creates offences of obtaining services dishonestly and of possessing, making, and supplying articles for the use of fraud. So the first one, section 2, is fraud by false representation. Section 3 is fraud by failing to disclose information. An example of section 2, fraud by false representation, could be falsification of timesheets, false information on job applications. Section 3, fraud by failing to disclose, can be failure to disclose dismissal from previous employer. And section 4, which is fraud by abuse of power, this could be budget holders, finance staff who abuse their position in committing a kind of a fraud. So it's really important when we look at the Fraud Act, the elements of the Fraud Act. Maintaining professional independence. So accountants must maintain professional independence from their clients. Accountant must avoid being biased, conflict of interest, undue or influence. So, your strength and your professionalism is important. You shouldn't be judging anyone. You should be, professional, and you should maintain the element of, being independent. Maintaining professional independence, a financial interest in it is an interest in shares, equity, or other security debenture, loan, or other debt instrument or entity. An indirect financial interest is a financial interest beneficial owned by through collective investment, estate, trust, or other intermediary over the individual or entity which has no current control. Direct financial interest is owned directly by and under the control of an individual or entity. Maintaining professional independence, and this is, in regards to businesses, they have policies in place that you shouldn't be accepting any sort of gifts or anything from clients. If they are offered to you, it could be any form of intimidation. So, you need to refer to your code of conduct in regards to gifts. It could be it could be that, you need to follow the elements, that gifts, there are parameters between that. And, you are not able to get any sort of gifts of clients. So you need to make sure you are following that, your policies and procedures. So the Bribery Act 2010. So the Bribery Act occurs when a person offers, gives, or promises to give a financial or other advantage to another individual in exchange or for improperly performing a function or activity. Being bribed is, like accountants, they could be bribed for, any sort of financial gain, which is, breaching their code of conduct. Policies for handling clients' cash. So, it's important when there are policies in place for looking after clients' monies. Client monies are funds or form of documents titled to money or documents of title which can be converted into money that a member of in practice holds on behalf of the client. They do not include fees or work done in paid of advance or use. So, you need to make sure that, this is all declared and you have policy client money protection in place. You shouldn't be you shouldn't be using clients' money, and, that client money, you need to keep records of it and demonstrate that this is a client account. So you should not be going into that. Policies for handling client money. So handling client money's self-interest threats, policies, separation, the use, as we've mentioned, and accountability. So you are accountable for that. So you need to make sure that all the money that you have put in is a separate account and you are following the company procedures in regards to clients' monies, and they're separate from any sort of other accounts of the firm or the organization. Policies for handling client money. Why not when not to hold clients' money. So they are monies of investment business. Clients are not regulated. Fraud Act, it falls within 2006 offences, section 2, 3 and 4. There's reason to believe they are criminal property. There's justification for holding the money, and there's no justification. There's a condition on your license. So it's really important that you know, to avoid trying to keep any sort of money from clients. Again, looking at confidentiality, what is confidentiality? Why is it so important? And disclosure. So a duty of confidence arises when one person discloses information to another circumstance where it's reasonable to expect the information will be held in confidence. And confidential information is defined as any data or know-how a disclosing party offers a receiving party orally or in writing or in private. The receiving party understands its confidential nature and any circumstance that would call for disclosure of any said information. So it's really important, you know, to identify confidentiality is one of the ethical and legal duty, but it's not absolute. So you may disclose personal information without breaching duties of confidentiality, but it all falls in within GDPR and the Data Protection Act. Confidentiality and disclosure carried on. Confidentiality is one of the elements of ethical principles which I've just mentioned and how important it is. Circumstances where you can disclose information would is things like when you are properly authorized to do so, when you have a professional duty or the right to do so, or when you have a legal duty, then you may be able to disclose it. So now in regards to learning outcome 3, we've finished learning outcome 3. The next learning outcome is learning outcome 4. There are some additional reading that you can go on to in regards to issues around any sort of ethics, criminal offences, bribery, computer misuse. There's links here that I've put on so you could refer to them so if you want to read any further reading or any additional reading, it's all on Moodle for you. So make sure you're going onto Moodle as well for any sort of ebooks, any sort of elements of additional reading, any sort of journal articles. Make sure you are referring to Moodle. This recording will also be on Moodle for Learning Outcome 3. If you have any questions regarding anything, please email learnerwork@ukvarsity.co.uk. Submission of the assignment to be done on learnerwork@ukvarsity.co.uk, and it's 2 weeks after the completion. So we've got learning outcome 4 to do and then the assignment discussion. Thank you for attending today's session. Thank you.